Hello and welcome back to the Jerusalem Post. I'm your host, as always, Tamar Uriel-Beeri, and today I am joined by Effi Shkolnik, a fixed income analyst with Bank Hapoalim, who deals with communicating with advisors and providing them with the data which they need so that they can provide more accurate and informed recommendations for clients, specifically relating to bonds. Effi, thank you so much for joining us today.
Thank you too.
So, we're going to talk 101 here. I have to understand on a basic level, what are bonds?
Okay, so let's start from the beginning. Bonds are a commercial loan that people can buy from the issuer. The loan combines from principal and interest that are paid from time to time as determined in the prospectus. As like in the loan or mortgage field, if I'm a risky client, I'll be charged a much higher rate from a wealthy one. So here, a riskier bond will pay us a higher rate of interest than a solid one.
Interesting. Okay, so the riskier is kind of the
yeah.
So I'm curious. We hear a lot about the financial situation in Israel and right now worldwide, especially with the pandemic having affected the economy as it has. How is this reflected specifically in bonds?
Okay, in the last years, we saw the economy suffers from a lot of damage from the pandemic and other things like the inflation, the commodity prices. So the central banks needed to lower their rates, and it affects immediately the bonds, the fixed income market. The mechanism in the fixed income market is when the bond price goes down, then the yield goes up, and the opposite side. So at 2 or 3 years ago, when the corona pandemic started, the central banks cut very quick the rates, and then people wanted to buy bonds in the previous price, so they bought it in higher prices, and they got the rates lower.
Oh, interesting.
What happens next is that the last years, most of people started to sell bonds or to go to the equity markets, because bonds were suffered from they had less interest from the public. The last year, the inflation took place, and the central banks needed to get the rates higher. And to make the economies work in the higher rates, it driven the fixed income market to higher rates and make it much more attractive.
Wow. Okay, so when I ask how has it been impacted, you're kind of saying a lot.
Yeah, of course.
And I'm curious, maybe this kind of equates to what you're describing right now, but how are bonds affected by changes in interest rates?
As I said before, when the central bank cuts the rates, the new bonds that are issued to the market are in lower rates. So the investors, when they comes to buy the new bond, the old bond, they buy it they afford themselves to buy it in higher prices, and the higher prices takes the yield down, and then it equals until it equals to the rates in the market. That's the things that I mentioned before. So when the central banks raise the rates.
Right.
Rise the rates at the bonds market and make them much more attractive to the investors.
Just for the everyday person, like not anybody who's particularly into banking, not anybody who's particularly into finance, why should that person care about bonds? How is it relevant to them?
Okay, that's a good question. Most of people don't know that they're already today investing in the fixed income field.
Oh, wow.
Most of us has pension funds, provident funds, or career funds, etc. And because of our risk aversion, we won't buy 100% of equity of stocks. We can afford that risk. So most of us has in our pension funds up to 60 or 70% of bonds today. In the pension funds, in our provident funds. So these days, most of people had a lot of bonds in their investing. All other investing.
So even if we don't we might not have known it about our pension plans, but we're already in the bonds field.
Yeah.
So you were talking about pension plans. How do bonds affect our pension plans, or how are they involved? What should we know about that?
Okay, so as the name of the sector, fixed income, the bonds provide us a fixed income. We can buy a bond in a rate, and then to ensure that we get a specific yield for the period of time. For example, if you buy a bond for 5 years, we know that we can get a 5% yield every year, and that's not as it's not like the equity market that it depends in the stock, it rises or falling down. At the bond market, if we wait until the end of the bond, it is for sure that we get the yield that we get when we bought the bond.
Pretty interesting. So if you had to choose, just in summation, what would be your top tips for a person recently taking an interest in their finances and wanting to work more with bonds, wanting to enter that field?
Okay, so when we buy a bond, there is of course safer bonds or riskier bonds. The government bonds are most of the time safer than the corporate bonds, because the government, most of them can print money, and they have their solid economies to support the bonds. And companies, the corporate bonds, it depends on the cash flow of the company. So one of the first tips is to see that we are not going to the lower rates of bonds. Rates, if I didn't mention it before, it's one of the ways to determine the risk of the bond. If there are a couple of rating agencies that rates the bonds, of course the government bond will have a higher rate than a corporate bond, and a big firm with a solid cash flow will have a higher rate than a company, than dangerous company or small company with no cash flow at all. So the tip is to focus in higher rate bonds, and not the high yield bonds, which most of the time don't have a rate or have a lower rate because the risk is higher.
I think this is one of those rare times that the expression "I'm taking that to the bank" actually applies very literally. Effi, thank you so much for joining us. I really learned a lot from you, and this isn't an easy subject to learn about, so I highly appreciate it.